I'm Lisa Abramowicz. Welcome to Bloomberg Money Undercover, a show that provides valuable insights into alternative investments. We take you inside the world of private debt, equity, and real estate. Well, let's get straight to those burning issues in private markets. Regulating private equity. The SEC looking to democratize private markets to open up exclusive corners of risk and return. Plus, one of the leading voices on credit and deals, Bill Brady, helps break down this year's distress in debt. And just for kicks, we take a look at how some investors are earning 6,000% returns by flipping sneakers. Let's get straight into some of these burning issues. With me, Bloomberg's Allison McNeely, Lisa Lee, and Jason Kelly. Let's start with Allison. Investors have debated how to understand this year's growing pile of distress in debt, given the fact that the U.S. economy is still pretty okay. So let's hear what Marathon's Bruce Richards had to say.
We're starting to see a negative quarter this past quarter of earnings growth being negative, and I think we'll see a couple more quarters of that in the early part of 2020. And when earnings go down, that's going to be a very key point for some of these companies that are so over-levered when they have lower earnings and meanwhile have to service these heavy load of debt.
So, Allison, you've been covering the distress that we've been seeing. Can we just start by talking about how much there's been so far this year?
So in November, we saw the supply of distressed debt hit 126 billion. That's the highest since about August 26, or the most, since August 2016, and really the highest of this cycle. But sort of historically speaking, that's really not that much in the grand scheme of things compared to, say, the financial crisis or even the highs of the oil crisis. So it sort of shows you that we're heading back up to that high, but there still isn't a lot out there.
Well, what's interesting to me is that in 2016, you had oil prices tanking, and a lot of the distress was in the energy patch. Again, we see issues with energy this year, even though oil prices didn't go down all that much. What went so wrong, and for whom?
Yes, so what we really saw this year was a lot of very idiosyncratic or company-specific situations. We've had oil prices stabilize in the $50 range, but for many companies, particularly those with very high debt loads, very high leverage, that's simply not enough to keep going. And we've seen them run into covenant issues, maturities, and also creditors who are just kind of tired of giving them more time.
And meanwhile, some of these big private debt companies are increasingly taking over for Wall Street. Lisa, how are the likes of Apollo and Blackstone plowing into Wall Street's domain?
Well, they've been in lending for quite a while now. But what's really changed is that there's just been a flood of cash into private credit, into direct lending. So they have bigger pools of capital to have bigger hold sizes and really eating into the market that was syndicated market.
All right. So how are they eating into Wall Street's underwriting business with leverage loans?
Well, they're doing deals at size at 1.8 billion, 1.6 billion. Deals that could have gone to the syndicated loan market so that Barclays or Goldman Sachs or CS might have arranged and sold to institutional investors. And direct lenders are just taking those deals away at the moment.
All right. And how much could they end up taking away from public markets, some of these Apollos and Blackstones of the world?
We're seeing a real emergence of a new asset class that's going to rival leveraged loans and high-yield bond market. So Apollo suggests that as much as 10% of the high-yield loan and debt market could go private in the next 5 years. That's a huge amount.
Yeah, and it brings up a lot of questions about the potential risk that gets embedded when you do have more of this business moving to private firms that focus on private debt, which brings me to Jason. And as we talk about risk, regulators are focusing in on private markets, but how to figure out ways to open them, not necessarily close them down or shut down risk. How is the SEC trying to democratize private debt and equity?
Well, it's a great question. And here in Washington, Lisa, they are looking at ways to make the pool at least a little bit bigger. This is a holy grail of sorts for the big private capital managers. They want more people to give them money, put simply. The SEC widening it just a bit, potentially, to say if you have certain certifications or if you are knowledgeable about the market by working with one of these financial firms, maybe you too can be an accredited investor.
So why? Why does the SEC want to open up the market so much?
Well, they've gotten a lot of pressure, candidly, from the firms themselves, but also there's this sense that everyday investors, or at least a broader scope of investors, are missing out on a lot of the gains and the profits that have been made in the private sector. You think about the gains that have been made on companies, say Peloton. Once they go public, those private investors, they look much better and more profitable than maybe the public investors. In the age of the unicorn, people want more access.
Yeah, although more access, but also this is inherently risky. And not only is it risky in terms of the actual investments, but it's risky in terms of the maturity profile. The fact that a lot of these investments don't really come to fruition for a long period of time. They're not that liquid. So what are the risks here?
Well, the risks are big, as you point out, and that's why we're here to some extent talking about this, why it hasn't happened before. The SEC is meant to look after investors and to keep them away from things that are, as you say, a little more risky. This is an opaque market in many ways. It doesn't have the transparency that a public stock market would, and people do lose money. And so you worry about folks going in to these investments not having the sophistication that maybe a professional investor would.
Jason, thank you so much for taking the time, and to all of our reporters. There is this question about the dynamism of equity markets, of public equity markets, with more companies going to direct listings or not even necessarily listing at all or going public. WeWork tried, it failed, but it's still in the news and still chugging along, this time with some financing details. Here to tell us more is Sri Natarajan, Bloomberg finance reporter. So Sri, let's start talking about WeWork. They needed this financing package in order to help its transition to more SoftBank control. What's the latest here?
The way I see it, this is SoftBank's first real hurdle clear in their effort to salvage their big investment bet. This gives the company some time to get its act together. Remember, we're just a few months removed from one of the greatest startup stories turned on its head. The IPO collapsed, and then SoftBank had to jump in with this big bailout package that gives them control of the company. The financing obviously gives them greater runway, gives them more time to sort of get back on the path to stability. But at the same time, it also opens up a boatload of cash that was tied up with their earlier credit line. So this is something, at least from a credit perspective, that becomes a little more appealing to investors. Still a long way to go, but a good start.
Well, hold on a second. Let's talk about what this financing package actually is. It's Goldman Sachs, right? And is it a loan that's going to stay on Goldman Sachs' books, or that they're arranging to syndicate out? How big is it?
So it's a $1.75 billion financing. Goldman committed to it last week. Goldman would not have done that unless it was confident that it could farm out pieces of that loan to other lenders. So how did they do it? How did creditors suddenly become comfortable with WeWork? Well, they added a simple twist. They made SoftBank one of the technical borrowers on this line of credit. So effectively, lenders will be taking the SoftBank credit risk way better than the WeWork credit risk. And that's why people have been able to get comfortable with it. That's why Goldman was willing to underwrite it. And that's why WeWork now has a sufficient amount of capital to play with.
Which is really interesting, because SoftBank is taking the risk on its books in a very real way, raising some questions about how much the Vision Fund is getting conflated with the overall business of SoftBank, which is varied and financial and perhaps a little bit less speculative than some of its startups. I'm wondering, what do we know? There was a feature in Business Week really talking about the culture within SoftBank. Can you give us a sense of what that's like and how that's informing some of these decisions?
First off, fabulous story. If you haven't read the story, you have to go to the nearest newsstand, pick up that Business Week piece. It's the cover story. We have fabulous reporters on it. And it really paints a picture of chaos, confusion, and more importantly, recklessness, right? And if you just look at the WeWork story itself, just a few months ago, Adam Neumann was marketing this as this grand tech play that will control the world. A few months later, we're just talking about a real estate company that is hoping to work off that real estate arbitrage to make sure that there is a feasible business here. And that goes to the broader SoftBank idea of whether was it really smart to go and tell all these startup founders, all these startup investors that you have to go big, grow at all costs, forget about profitability. The conversation has shifted to figuring out whether profitability is what they need to focus on, at least first off.
Sri, thank you so much for taking the time. We really appreciate it. Coming up, this week's power player, Bill Brady, head of the alternative lender and private credit group at the law firm Paul Hastings. He says the economy has a good tailwind, but there are still warning signs.
Leverage is high. The margin for error is low. And so we really have winners and losers in terms of, which deals are succeeding and which ones aren't.
I'm Lisa Abramowicz. This is Bloomberg Money Undercover. Now time for Power Play, our look at some of the most notable names in private markets. This week, we wanted to dig into the question of how to understand the rising volume of debt trading at distress levels. Is this a leading indicator of stress in the U.S. economy, or rather a sign of a healthy market where investors are actually using discretion? I sat down recently with Bill Brady, head of the alternative lender and private credit group at the law firm Paul Hastings, and we spoke about where we are in terms of the balance of deals that are falling apart versus coming to market.
3 months ago, I would have told you it's 50-50. The pendulum's now swung back a little bit more the other way, so it's probably 70% front-end deals, very competitive, highly sought-after deals, and 30% restructurings. But it's really, for the first time in my 20-year career, it's typically 95-5, one way or the other, right? The markets are hot, deals aren't being restructured, or we have a recession 10 years ago, everything's being restructured. This is the first time in my career where we're busy on both ends.
What does that tell you?
From my perspective, I think it means that there's still a pretty good tailwind economically, but leverage is high, the margin for error is low, and so we really have winners and losers in terms of which deals are succeeding and which ones aren't.
There's a sort of belief out there that the pain and the restructuring has been isolated to energy and retail. Is that the reality? Is this just a sector-based problem, or is this something else having to do with leverage and the structuring of deals?
It's more concentrated in those areas, but it is both. And I could close my eyes and pick 10 restructurings off my desk, and it might be 10 different industries. It really is across the board. Now, again, there's more concentration in troubled industries. Obviously, retail is a big one. But with high leverage, if management makes a misstep, they can find themselves back at the table.
Given the fact that it is so prevalent, some of the EBITDA add backs or the leakage, as you talk about, paying dividends, et cetera, do you think that the next cycle is going to be really painful, more so than people are perhaps prepared for?
No, I actually think, well, it depends on which people and which constituents. I think for for some of the shareholders, it may be painful. But there's so much dry powder on the sidelines. There's a lot of distressed funds that have been raised, and they haven't been deployed yet. The cash hasn't been deployed. But unlike 2009, whenever the next recession comes, and I frankly don't think it's coming that soon. I've been saying that for 5 years.
Congratulations, you've gotten it right.
For the last 5 years.
For the last 5 years.
I do think it'll be a softer landing, because in 2009, when the banks pulled back, you didn't have these billions and billions and billions of dollars of distressed debt funds ready to come in, and even other kind of funds, private debt funds, rescue funds. So there was a hard landing for a lot of companies. I think a lot of those borrowers today will have a softer landing, but there's a price, right, for the distressed lender to come in. They're going to be compensated for the risk, and that compensation is going to come in the form of, probably a higher interest rate, probably a huge equity kicker. They're going to take a big piece of the equity. But for the company, and also ancillary to that, jobs, I think, can be saved through that softer landing.
Do you think that private debt funds are going to significantly outperform private equity funds over the next 5 to 10 years, just based on what you were talking about, the dynamic of private equity perhaps being the one that feels the pain much more than the lender?
There are a lot of experts, pundits, talking about the next recession's coming. There's a number of people saying it's not coming. There is still a period of time yet to go before the next recession hits. Now, when that happens, and it always does, right, at some point, I do think the private debt funds will be pretty well positioned in the market, notwithstanding the high leverage, because the private debt funds, many of them have the underwriting capability and the appetite where if they have to own it, they will. They're not in the business of loan to own. They're in the business of lending. But they have the personnel with the private equity background, and this is part of my practice as well. If for unforeseen reasons the lender has to take the keys, they have the capacity. They can bring in the experts. They can turn around the business, and 3 to 5 years later they can sell it and possibly recoup not only their equity but a good portion of their debt.
That was my conversation with Bill Brady, head of the alternative lender and private credit group at the law firm Paul Hastings. The takeaway, perhaps, is that distress in credit has remained confined to specific companies, idiosyncratic, if you will, but does speak to a bigger issue in terms of how deals are being crafted. There are good deals and bad deals, but the thing is that when things do go bad, recoveries will probably be a lot lower, which means that losses may be significantly higher than they've been in the past. Still, the economy seems to be chugging along. Coming up, you may be surprised to know that the global resale shoe market has reached billions of dollars. Next, we talk to an executive who left Wall Street to cash in on this booming market. This is Money Undercover on Bloomberg. I'm Lisa Abramowicz. This is Bloomberg Money Undercover. Time for Trendsetter, or look at a person in the private markets that is blazing a new way, and in this case, a new asset class. Scott Cutler is previously the head of global listings of the New York Stock Exchange. Now, he's doing listings of a different kind as the CEO of a sneaker exchange called StockX, which is becoming a booming part of the shoe market. I asked him how this market works and what drives consumers to his business.
Today's consumer wants access to amazing brands, but they also want to make sure that those brands are authentic. And as a platform of a stock market of things, which was the original concept of this business, it's transformative to have a marketplace that's powered by sellers from around the world, but giving access to authenticated items has really been the differentiator and why this is one of the fastest growing e-commerce companies anywhere in the world.
How do you check the authenticity? Do you actually guarantee it?
Yeah, so as you look at the product experience, it starts with coming to a page that's a product. It's the only place that you can find it. That product is very transparently available to the customer at prices that people can see. And then once that transaction is completed in a very much stock market-like way, where you can bid on a sneaker, you can ask or sell a sneaker and other items. But then when that transaction is completed, the most important part is that every one of those items goes through an authentication center somewhere around the world. For us, we authenticate and inspect every item for its authenticity before it's sold out to the end consumer. It's created a high level of trust for great brands in a marketplace-like experience.
Is there a market size for the resale sneaker market? I mean, I'm just thinking about one pair of sneakers that sold for $50,000. Is that sort of par for the course here?
Well, if you look at the entire sneaker market worldwide, it's estimated to be a $100 billion market. The resale component this year is estimated to be over $7 billion, and it's been growing at roughly triple-digit growth rates. So that's significant relative to even the e-commerce size of the sneaker market alone. And so what we're seeing is really just explosive growth relative to general e-commerce rates. But we're also just seeing effectively a very different value proposition, which is people coming, trying to find that new release that they can't find from the brand, that they can't get from the retailer, and coming to StockX because it's about access. It's about something that's not available anywhere else, and you're buying it as if it's in its original condition for the very first time.
So Nike recently launched a brand on the StockX exchange. Adidas has done something similar. I'm wondering why they're coming to you to debut their items.
Well, we did an IPO, an initial product offering with Adidas, which is obviously one of our top-selling brands on the platform, in October. It was a new revolutionary way to release product that in this case was never again to be recreated out of their maker lab. We released those to the market in a unique way, and they priced above what they would in retail, and we had over 10,000 people that came to bid on those items. And so over time, we actually expect that brands and the brands that sell on our platform to work with us directly because the consumers are here.
What are you seeing in terms of returns and people using sneakers as a sort of investment vehicle? Because I saw one story about a return of 6,600%.
Yeah, so it's amazing. This has become an asset class of people that do collect hold on to these items and trade these. Obviously, a sneaker that would be trading at thousands of dollars originally retailed at $200. I look at my own portfolio of sneakers this year, well outperformed the S&P, well outperformed the rest of the market. But I think it's also just an acknowledgement that these are items that have persistent trading value. And there's a lot of people that are actually using the platform to fund a college education, to fund a platform, to fund their business and their passion.
Scott, I cannot wait until I ask somebody, how did you fund your child's college education? And they say, flipping sneakers. I do have to wonder, though, what the logic is here of the appreciation of sneakers over time, because under my use, they tend to lose value over time as I use them. And I'm just wondering, how do you ensure this isn't sort of a repeat of tulips?
Yeah, so this is important. We started with this concept of a stock market of things, where at any given time, the price of a product that we show transparently is very visible to the consumer. And that price actually varies from minute to minute. The difference on our platform is that what you're buying is a product that is in what's called in sneakers dead stock condition, which means it's the same condition as if it was originally released. It's not used, it's not worn. And so what's interesting is that while releases drive a lot of people to get access to the product, they actually come back and they look at items that may have been released 8 weeks ago to maybe 10 years ago, and they're buying that product as if it were the first time. And so different than other sites that are selling used items, you're talking about access to new items in their perfect condition. And some of these things actually have appreciated significantly over time because, quite frankly, the supply of these things is much more scarce. It's limited. It's not available.
That was my interview with StockX CEO Scott Cutler. It's time for this week's big number. It's been a historic year for female-founded unicorns. In 2019, there were 21 startups founded or co-founded by a female that passed the $1 billion valuation mark. This includes beauty brand Glossier, men's wellness company Hims, and the international payment startup Air Wallex. In 2018, there were only 15 unicorns born with at least one female founder. That does it for us. Happy holidays to everyone. Reminder, you can watch us each Tuesday at 1 p.m. New York time, 6 p.m. in London, and 2 a.m. in Hong Kong. This is Bloomberg.